What's up everybody, it's Sergey Yakimov, and today we're diving deep into the world of investing with wisdom from the godfather himself, John Bogle. You know him, you love him, the legend who founded Vanguard and basically invented index funds as we know them. Bogle dedicated his life to making investing accessible to everyone, not just Wall Street hotshots. He believed in a simple, common-sense approach that anyone could follow. We're breaking down his 10 golden rules for investment success. Think of it as your roadmap to financial freedom. So buckle up, smash that like button, and let's learn how to build wealth the Bogle way. Rule number 1 is all about keeping your head cool in the market roller coaster. See, investors tend to chase returns. We see a stock soaring, everyone's talking about it, and we jump in right at the peak. But what goes up must come down, right? That's reversion to the mean. Today's hot stock could be tomorrow's flop. Don't fall for the hype. Instead of chasing past performance, focus on the long game. Look for solid companies with strong fundamentals that can weather the market's ups and downs. Remember, slow and steady wins the race. Investing isn't about getting rich quick, it's about building wealth over time. This one's all about patience, people. Time is your greatest ally when it comes to investing. Forget trying to time the market, it's a fool's game, even the pros get burned. The longer you stay invested, the more that money has a chance to grow exponentially. That's the magic of compound interest, your money making babies and then those babies making babies. It's like a snowball effect. But the key here is to start early. Even small amounts invested consistently over time can add up to significant wealth down the road. So don't wait for the perfect time to start investing. The best time was yesterday, the second best time is right now. Now what does Bogle mean by buy right? He's talking about diversification. Don't put all your eggs in one basket, folks. Instead, spread your investments across different asset classes like stocks and bonds. And the easiest way to do that is with, you guessed it, index funds. Index funds are like the diversified all-stars of the investment world. They track a specific market index like the S&P 500, so you're essentially buying a tiny piece of hundreds of companies. This spreads your risk and gives you exposure to a broad range of sectors. And once you've bought into those diversified funds, hold tight. Don't panic sell when the market dips. Remember, it's a marathon, not a sprint. Now I know what you're thinking, Sergey. I want to be driving a Lambo next year, not in 30 years. Look, getting rich quick is a fantasy. It's like that sugary donut, tempting in the moment, but ultimately empty calories. Investing is more like choosing a hearty, nutritious bagel. It might not be as glamorous, but it's what's going to sustain you in the long run. Set realistic goals for yourself. Don't expect to get rich overnight. Focus on steady, consistent growth over time. Remember, slow and steady wins the race. This one's simple. Stop trying to be a stock-picking genius. Seriously, it's like trying to find a needle in a haystack. Even professional stock pickers struggle to beat the market consistently. So, what's the alternative? You guessed it. Index funds. Instead of wasting time and energy trying to outsmart the market, buy the entire haystack. Index funds give you broad market exposure, so you're not betting on any single company or sector. It's a simple, low-cost, and effective way to invest. Ever noticed how the house always wins in a casino? Well, Wall Street's no different. Every time you trade stocks or invest in expensive mutual funds, you're paying fees. To brokers, fund managers, you name it. Those fees might seem small, but they eat into your returns over time. Bogle called this the croupier's take. And guess what minimizes those fees? You got it. Index funds. They have super low expense ratios, which means more money stays in your pocket. Remember, every penny saved is a penny earned. Chapter 7. There's no escaping risk. Look, there's no such thing as a risk-free investment. Even stuffing your money under the mattress comes with the risk of inflation slowly eating away at its value. Inflation is a silent killer, folks. But here's the thing. Stocks have historically outperformed bonds over the long term. Why? Because companies have the potential for growth. They can increase profits, innovate, and adapt to changing market conditions. Bonds, on the other hand, offer fixed returns. Now, this doesn't mean you should go all in on stocks. It's all about finding the right balance for your risk tolerance and investment goals. Chapter 8. Don't fight the last war. Just because something worked in the past doesn't mean it'll work in the future. The market is constantly evolving. What worked during the dot-com boom might not work in today's tech landscape. Remember those flip phones? Yeah, those were a thing once. Don't be afraid to adapt your investment strategy as market conditions change. Stay informed, do your research, and don't be afraid to adjust your sales if needed. Chapter 9. The Hedgehog Beats the Fox. This one's a bit philosophical, but stick with me. Bogle was a fan of Isaiah Berlin's essay, The Hedgehog and the Fox. The fox, clever and cunning, knows many things. The hedgehog, simple and focused, knows one big thing. In the world of investing, the hedgehog is the index fund. It focuses on one thing, owning the market. The fox, on the other hand, is the actively managed fund. They try to outsmart the market, but they often fail. Why? Because stock picking is hard and even the smartest foxes can get it wrong. So be a hedgehog, not a fox. Keep it simple, stay focused, and invest in index funds. Chapter 10. Stay the course. Congratulations, you've reached the 10th and final rule. This one's all about discipline and commitment. Create a solid investment plan that aligns with your financial goals, risk tolerance, and time horizon. Once you have a plan, stick to it. Don't let emotions dictate your investment decisions. Remember, the market will have its ups and downs. Don't panic sell when things get rough. Stay the course, ride out the volatility, and let the power of compound interest work its magic. Outro: Build Wealth the Bogle Way. So, there you have it. John Bogle's 10 simple rules for investment success. Remember, investing doesn't have to be complicated. Keep it simple, stay disciplined, and focus on the long term. Don't try to outsmart the market or chase the latest hot stock. Instead, invest in low-cost index funds, diversify your portfolio, and let the magic of compound interest work its magic. Remember, the best time to start investing was yesterday. The second best time is right now. So what are you waiting for? Go out there and build wealth the Bogle way.